Find your last payslip, not the number they told you at the interview, the other one, the one at the bottom. There is a gap between those two numbers, and for most Americans, it is somewhere between a fifth and a third of everything they earned that month. You have never held that money. It did not arrive in your account and leave. It did not sit there for a day. It went from your employer to the government without passing through your hands at any point, and the first time you saw it was as a line on a piece of paper telling you it was already gone. That is not how taxes work by nature. That is a design. For the first 30 years that Americans paid income tax, nobody withheld anything. You earned your money, all of it. It went into your account, or your pocket, or your kitchen drawer. And then, once a year, on the 15th of March, you sat down and wrote the government a check for a very large number. You felt every dollar of it because you had to physically hand it over. Then, in the middle of a war, that stopped. And it stopped so completely that today an American can work for 40 years and never once write a check to the Internal Revenue Service. The part I keep coming back to is this. The man who helped design the system that takes your money before you see it spent the rest of his life saying he wished it could be abolished. He was 30 years old, he worked at the Treasury, and he is one of the most famous economists of the 20th century. And the man who made the whole thing politically possible was not a politician or an economist at all. He was the treasurer of a department store. We are going to look at what paying tax felt like when you could feel it. We are going to sit through the campaign the government ran to persuade 50 million people to start paying, a campaign that involved Donald Duck and a hit song. We are going to watch a year of American taxes get canceled, which really happened and almost nobody knows it. And we are going to end on the question that is actually at stake here. Does a tax you cannot feel stay the same tax? Let's open the vault. Start with what it used to be like, because the difference is not small and it is not technical. Before 1943, the income tax worked the way a bill from a builder works. The year ended. You added up what you had earned. You worked out what you owed. And on the 15th of March, you sent it in. Not a portion of it every payday. The whole thing, months after you earned the money it came out of. Think about what that requires of a household. It requires you to look at money in your own account, money you can see and touch and spend, and understand that a large part of it is not yours. It requires you to not spend it for a year. And it requires you, on one specific day in March, to sit at a table with a pen and write out a number and sign your name under it. There is no way to do that absent-mindedly. Whatever else you can say about that system, the citizen knew exactly what the government was taking because the citizen handed it over personally. That was the arrangement for 30 years, from 1913 to 1943, and it worked, as long as the number of people doing it stayed small. And it was small. That is the part people forget. The income tax in the 1930s was not a thing most Americans dealt with. It was a tax on the comfortable. If you worked in a factory or on a farm, you almost certainly did not pay it, did not file, and did not think about it. It sat somewhere on the edge of ordinary life, like a tax on yachts, which is why the whole apparatus was built for a manageable number of people who could reasonably be expected to save up. Then the war came. A war costs money on a scale that is genuinely hard to picture, and there are only 3 places to get it. You can borrow it, you can print it, or you can tax it. The United States did all 3. But the tax part is where the shape of American life changed, and it changed in one piece of legislation. The Revenue Act of 1942 pulled the income tax down out of the comfortable classes and dropped it onto everybody. Look at what that did to the numbers. Before it, something like 13 million Americans paid income tax. After it, around 50 million. Read that again. In a single step, the number of Americans who owed the federal government money every year nearly quadrupled. Tens of millions of people who had never filed a return in their lives, who had no accountant and no reason to have ever thought about it, were now taxpayers. Historians have a phrase for this. They call it the move from a class tax to a mass tax, and it is not an exaggeration. The income tax stopped being something that happened to other people and became something that happened to everyone with a job. Now put yourself inside the Treasury Department in 1942 and look at the problem you have just created. You have 50 million taxpayers. The overwhelming majority of them have never done this before, and your entire collection system is built on one assumption, that the taxpayer will set aside a large sum of money over 12 months and hand it to you in March. 50 million people, most of them living paycheck to paycheck in a country just out of a depression. Asked to voluntarily hold back a fifth of their income for a year and then write the largest check of their life. That was never going to work, and everybody involved knew it. So before we get to how they fixed it, look at what they tried first, because it is one of the strangest campaigns an American government has ever run. They tried persuasion. In January of 1942, the Treasury Department released a cartoon, not a poster, not a pamphlet. An animated short, made by Walt Disney Productions, commissioned personally by the Secretary of the Treasury, Henry Morgenthau, Jr. It was called The New Spirit, and its star was Donald Duck. The plot is exactly what you think it is. Donald hears on the radio that his country needs him. He is thrilled. He assumes this means something heroic. It turns out to mean filling in his tax return. And then the cartoon sits with him at a table and walks him through the form. Stop and consider what it means that this exists. The government of the United States, in the middle of a world war, concluded that the most effective way to reach the American public about a tax form was to have a cartoon duck do it. And it worked, in the sense that enormous numbers of people saw it. It went out to cinemas across the country in front of the feature. Then there was the song. Irving Berlin, the most successful songwriter in America, the man who wrote White Christmas, volunteered to help. He wrote a number called I Paid My Income Tax Today. It is cheerful. It is catchy. Its entire subject is a man who is delighted to have handed his money to the government. The rights to that song are still held today by the Internal Revenue Service. I want to be fair about the tone of all this. It was wartime. The country was united in a way it very rarely is. The cause was real, and none of these people were cynics. But look at what the campaign tells you about the underlying problem. You do not commission Disney and Irving Berlin to explain something people find easy. You do that when you are trying to persuade 50 million reluctant strangers to do something difficult on their own initiative with their own money. And persuasion alone was not going to close the gap. The Treasury still needed the money to actually arrive. The solution came from a man who did not work in government. His name was Beardsley Rumell. And to understand why this story is strange, you need to know what he did for a living. He was the treasurer of R.H. Macy and Company, the department store. He was also, at the same time, the chairman of the Federal Reserve Bank of New York. Sit with that combination for a second, because it explains everything that follows. Here is a man who spends his working life at a retailer, watching how ordinary people actually handle money. He knows something that Treasury economists in Washington do not know in their bones, that customers do not save up, they pay when they buy. A store that asked its customers to settle up once a year, in March, for everything they had taken off the shelves would not last a season. Rumell looked at the income tax and saw a store with terrible payment terms, and he had watched the alternative work in his own business for years. Department stores in that era ran on installment credit. Buy the furniture now, pay a little every month, not because the stores were generous, but because it was the only way ordinary households could ever afford the furniture, and the only way the store would reliably see the money. Rumell understood something the economists in Washington were not positioned to see. The question was never whether people were willing to pay. It was whether the timing of the payment matched the timing of the earning. Get those two out of step, and you do not have a tax problem, you have a collections problem, and collections problems are solved at the counter. His fix, which he worked out around the winter of 1940 and 1941, was the thing we now live inside. Stop asking people to pay last year's tax. Take this year's tax out of this year's paycheck, a little at a time, automatically, before the money ever reaches them. Pay as you go. And this is where it becomes a real fight, because Rumell's plan had a problem. And the problem is the most interesting thing in this entire story. If you are going to switch people from paying last year's tax to paying this year's tax, then for 1 year they owe both. They owe the tax on the year that just finished, under the old system, and they owe the tax on the year they are in, under the new one. 2 full years of income tax, in 12 months, from people who could barely manage one. That is not a policy detail. It is the whole obstacle, and it is why nobody had done this before. Rumel's answer was breathtakingly simple. Cancel one of them. He proposed that the government simply forgive an entire year of tax liability. Wipe it. The transition costs nothing to the citizen, the new system starts clean, and from then on, the money arrives steadily and forever. The Roosevelt administration's tax experts hated it. Their objection was not stupid. They said that wholesale forgiveness was unnecessary, inequitable, and inflationary, that it handed a windfall to people who owed the most, which is to say, the wealthiest, and put money into an economy that already had too much of it chasing too few goods in wartime. That is a serious argument, and it was made by serious people, and they lost. The fight ran through the spring of 1943, and it was not quiet. Rummel, a department store treasurer with no seat in government, went up against the President of the United States and his entire tax staff, in public, over how Americans would pay for the war. He won. Not completely. The compromise that came out of Congress forgave 75% of 1 year's tax liability rather than the whole thing, with the wealthiest getting less relief than everyone else. But he won the thing that mattered. The principle went through. On the 9th of June, 1943, Franklin Roosevelt signed the Current Tax Payment Act. I want to say the next sentence plainly, because it sounds like something invented on the internet, and it is not. 3/4 of a year of American income tax was canceled. Not deferred, not spread out. Canceled, by act of Congress, signed by the President. If you were an American with a job in 1943, a large part of 1 year's tax bill simply stopped existing. What makes it strange rather than generous is this. Almost nobody experienced it as a gift because of what arrived at the same moment. The forgiveness was invisible. It was the absence of a bill you had been dreading. What was visible was the new deduction appearing on your pay envelope every single payday for the rest of your working life. The government canceled a debt with one hand and installed a permanent tap with the other, and the tap is the part everyone remembers. Look at the trade from the Treasury's side, and it is one of the best deals any government has ever made. It gave up part of 1 year of revenue. In exchange, it got a collection system that never misses, never has to chase anyone, never depends on a citizen's discipline or goodwill, and never has to be argued for again. It bought permanence with a single year's discount. Now bring it down to one household, because a national figure is not a thing anyone can feel. Take a man working in a shipyard in 1943. 2 years earlier, he had never filed a tax return in his life. He was not the sort of person the income tax was for. Then the war came, the rules changed, and suddenly he owed. He spent 1942 knowing that a bill was building somewhere out of sight, and he had no more idea how to save for it than he had of how to fly a plane. Then, in the summer of 1943, 2 things happened to him in the same week. Most of that dreaded bill is written off. It is gone. He will never have to find that money. And on his next pay envelope there is a new line, and the envelope is lighter, and it will be lighter every Friday for the next 30 years. You ask him which of those 2 things he noticed. The forgiveness was an absence, a letter that never came, a knock he had been bracing for that did not happen. Absences are hard to see. The deduction was a presence, and it was in his hand every week for the rest of his working life. That asymmetry is not a side effect. It is the whole reason the arrangement held. A one-off relief that nobody quite registers, traded for a permanent extraction that nobody can quite object to, because by the time you might object, the money has already gone somewhere else. Now the man I mentioned at the start. In 1941, a 30-year-old economist went to work in the Division of Tax Research at the Treasury Department. He was part of a small technical group given a narrow practical problem. Work out how, mechanically, you would take tax out of a paycheck, how the tables would work, how employers would calculate it, how to make it possible. His name was Milton Friedman. If that name means nothing to you, here is the short version. Friedman became one of the most influential economists of the 20th century and the most prominent intellectual defender of limited government in America. He won the Nobel Prize. He spent decades arguing that the federal government was too large and took too much. And at 30, in a government office during a war, he helped build the machine that makes taking it painless. He never denied it, and he never pretended it away. What he said in later life was this: he had no apologies for it. He did not think it was wrong to have found a way to fund a war they had to win, but he wished they had not needed to, and he wished there were some way to abolish withholding now. The distinction he is drawing there is the whole point of this episode. He is not saying withholding was a bad solution to the problem of 1943. He is saying that a mechanism built for an emergency became the permanent architecture of how citizens relate to their government, and that the permanence is the part nobody chose. We have run into this exact shape before on this channel, and it has a name. A measure gets introduced under genuine pressure for a real reason, with an argument behind it. The pressure ends. The measure does not. And a generation later, it is not a policy anymore. It is simply the way things are, and nobody can point to the moment it was decided to keep it, because there was no such moment. The emergency was the war. The war ended in 1945. The withholding did not. There is a detail about Friedman's position that I think gets lost when people tell this story as a gotcha. He was not a hypocrite who changed his mind when it became convenient. He was a young technician, handed a problem in wartime, and he solved it well. The judgment he made later was not about the solution. It was about what happens to a solution when the conditions that justified it disappear and nobody is assigned to notice. That is a much less satisfying story than famous small government economist secretly built big government, and it is the accurate one. I would rather give you the accurate one. But it does leave a hard question sitting on the table, and I do not think it has a comfortable answer. If the most effective way to fund a government is to collect from people in a way they cannot feel, then every government will eventually find that method, and no government will ever voluntarily give it up. Not because anyone is villainous, because it works. The men who built this were not trying to hide anything. They were trying to win a war and to spare 50 million households a bill they could not pay. Both of those were good aims. And the machine they built to serve them is still running 80 years later, in a country that has been at peace for most of that time, and it has never once been put to a vote. So what actually changed beyond the plumbing? Start with the raw number, because it is stark. In 1939, income taxes collected came to around 1% of personal income in the United States. After the new system came in, that figure went above 11%. Some of that is the wider tax base and the wartime rates. But part of it is simply that the money now arrived, reliably, from everyone, without anyone having to be persuaded. And then there is the part you cannot put a number on, which is what it did to how the tax feels. Under the old system, the tax was an event. It had a date. It had a physical act attached to it, the pen, the check, the envelope. It happened once a year, and it hurt once a year, and because it hurt, the citizen had an opinion about the size of it. Under the new one, the tax is a subtraction that occurred before you were involved. There is no moment. There is no act. There is a smaller number at the bottom of a page. You cannot be angry at an absence in the same way you can be angry at a payment. This is exactly what Friedman was pointing at, and he was not the only one. The argument runs like this: a tax you never handle is a tax you never really weigh. And a tax nobody weighs is much easier to raise, because raising it does not produce the one thing politicians actually fear, which is 50 million people sitting at 50 million kitchen tables in March, writing a bigger number than last year. Now the fair objection, because there is one and it is strong. Withholding is not a trick. It is genuinely easier for almost everybody. It spares people the discipline of saving a fifth of their income for a year, which many households simply cannot do. It prevents the disaster of arriving at March with the money gone and the bill due. It is also vastly more efficient to collect, which means the same revenue costs less to gather. If you asked most Americans to switch back tomorrow, to receive every dollar and settle up once a year with a single enormous payment, a great many of them would refuse, and they would have good reasons. Both things are true. It is easier, and it is quieter. The system that makes it painless is the same system that makes it unexamined, and you do not get to keep one without the other. One more thing belongs on the table, and it is the strongest evidence that the invisibility is doing real work. Watch what happens every spring. Millions of Americans receive a refund, and a great many of them treat it as good news, as money arriving, a windfall, something to spend. But a refund is not a gift. A refund means the government took more of your money than it was owed, held it for up to a year without paying you anything for the privilege, and then gave the excess back. If your bank did that, you would change banks. When the tax system does it, people are pleased. None of that is because anyone is foolish. It is because the deduction happened where you could not see it, and the refund happens where you can. One is invisible and one arrives with your name on it, so the one that arrives feels like the real event. 80 years on, the design is still working exactly as intended. It was built to move money without producing a moment, and it does not produce a moment, not when it takes, and not even when it gives back. So step back and look at what happened. A country at war needed money from 50 million people who had never paid before, and asking them nicely was not going to work. A department store treasurer supplied the answer that retailers had known forever. Do not send people a bill, take it at the counter. To make the switch possible, 3/4 of a year of taxes were canceled outright, and a 30-year-old economist worked out the mechanics, then spent the rest of his life wishing there were a way to undo them. The war ended. The machine stayed. Not because anyone defended it, and not because anyone voted to keep it, but because a system that collects money without friction gives nobody a reason to stand up and complain about it on a particular Tuesday. It is the quietest possible arrangement, and quiet is exactly what it was built to be. What I would take away from this is the shape of it. The most durable government policies are not the loudest ones. They are the ones designed so that you never have to notice them, and the design is not an accident. Someone sat down and worked out how to make it invisible, and they were good at their job. So here is my question for you. What else are you paying for that you have never once had to hand over? Tell me in the comments. I read them. And the next time you look at a payslip and your eye slides past the middle of it to the number at the bottom, remember that the sliding is the product. Somebody in 1943 designed that on purpose, and it has worked on you your entire life. You have never held that money. You were never supposed to. If you want more of these, the parts of ordinary life that turn out to have a start date, subscribe and open the vault with us. There is another one waiting for you right here.